Today is Monday, Feb 2nd, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, Mark Bowman, and JP Steiner, all from the ADMIS Research Team. And starting with JP this morning, JP, what caused the volatility in the precious metals on Friday?
Friday was certainly a historic day for the precious metal space, with silver falling over 31%, while gold also notched a double-digit percentage fall as well. There were a number of factors that contributed to Friday's frenzy, but I would say the main thing was that it was an outsized rally that quite simply fell off a cliff. Getting into it a little more, though, the CME did adjust their margin requirement higher. That caused retail traders to exit their positions due to a lack of liquidity. That is also expected to keep silver under a little bit of pressure as well. We also saw strong moves in the dollar following the nomination of former Fed Governor Kevin Warsh to lead the Fed. That news has been certainly dollar positive and weighed on precious metals prices, since, of course, precious metals are priced in U.S. dollars. So a rise in the dollar making it a little less affordable for foreign buyers. Ultimately, though, I would say that silver was experiencing a strong fear of missing out rally ever really since the beginning of January. That was supported by strong retail investor demand. Friday, we saw an unwinding of ETF and options positions. That likely was triggered by end-of-month institutional flows, as well as some strong repositioning from institutional traders as well. That likely caught traders off guard and triggered the wave of selling as people were caught in the slide. Now, I would say the case for silver still remains supportive, but going forward, I would expect continued volatility in the metal. The recent influx of investor attention has provided a bit of liquidity, but also resulted in some of these outsized price moves that stretch far beyond fundamentals. Silver is set to remain in a structural supply-demand deficit due to its dual use, especially its use in several industries, mainly the technology sector, while its role as a safe haven leads silver flows to warehouses for investor protection. Industrial demand does account for roughly 60% of total demand for the metal. That also raises the risk that higher prices will deter industrial users from buying. So really, a multitude of factors led to the dramatic drop on Friday, mainly the exit by retail traders as higher margin requirements and stronger dollar pressured liquidity.
Thanks, JP. And what should we expect from this week's central bank meetings?
Yeah, we have several central bank meetings, mainly the Bank of England, European Central Bank, and the Reserve Bank of Australia, all meeting this week. Now, markets are expecting the Bank of England and European Central Bank to hold on rates, while a rate hike from the Reserve Bank of Australia is anticipated after recent data has pointed to an upside in inflation in what is set to be a bit of an embarrassing policy error after the bank had previously cut rates prematurely in 2025. Australia's annual inflation climbed up to 3.8% in December, with the trimmed mean CPI inching up to 3.3% year over year from a prior reading of 3.2%. Recent figures have also shown that capacity utilization in the economy is stronger than expected. Growth has been very robust. Unemployment is low, and PMI readings have pointed to strong private sector activity. Now, with the change in the macro landscape in the country, focus will be centered on how aggressive this tightening cycle may be from the RBA. Commentary from the bank is likely to be hawkish. The bank probably wants to make its intentions known that it is serious about fighting inflation. Moving on to the Bank of England, rates are expected to be on hold following a tight 5-4 vote to cut rates back in December. This time, policymakers likely to be in much more of an agreement that rates should stay steady as inflation still persists above the bank's 2% target, even though it has shown signs of easing. I would say rates for the Bank of England are likely to fall in the coming months. There is signs of a cooling labor market and easing wage growth. Those factors are likely to alleviate underlying price pressures in the economy. Still, markets will be paying attention to the composition of Thursday's vote for signals on the pace of interest rate cuts down the line. The bank will also be updating its forecast for growth and inflation as well. Now, last but not least is the European Central Bank. It's no secret that the ECB is likely to remain on hold for some time as inflation is not expected to deviate much this year and into 2027, while growth in the trade bloc has proven to be better than expected. That will leave focus on any signals about how the bank may respond to rising risks and what direction the next move will be. There's been a lot of talk recently about a stronger euro, as well as renewed geopolitical uncertainty. That does present the risk of a slight dovish tilt from the ECB in their outlook. Recent comments from several European central bank officials have sparked some concern that a stronger euro would necessitate a rate cut from the bank due to its deflationary pressures. But likely, I would think markets would need to see a clean break above the $1.20 level for some time before getting too excited about pricing in a rate cut any earlier than expected.
Thank you, Mark Soderberg. The grain markets continue to be fairly range bound. Do you expect volatility across the agricultural markets to pick up anytime soon?
Yeah, by comparison, prices across the ag space have been rather tame, particularly when you look at the volatility, as JP is talking about in the metals and then some of the softs and energy markets as well. And in short term, no, I don't think that's going to change real quickly. February is often a rather quiet month across the ag space here in the U.S. Farmers are awaiting the arrival of spring and the new crop planting season. Unfortunately, prices for them remain low, at least compared to their input costs. So they're not terribly eager to want to jump out and start forward contracting much of next year's crop. Coming off of last year's record corn harvest and record yielding soybeans, they're still holding a fair amount of last year's crops in the bins. And every single time we seem to get a little bit of a price rebound that's quickly held in check as farmers look to move some of that old crop inventory. In South America, weather has been largely favorable to date. In Brazil, as farmers now are starting to harvest what will almost certainly be a record soybean crop down there. In Argentina, heat and drought stress, that's impacted a sizable amount of corn and soybean acres across the east, central, and southern growing areas. However, they are expected to see a return of rains here this week and next, and if they're verified, could still produce an above-average crop. So the supply side has really not been an issue. On the demand side of the equation, we're exporting a record amount of corn, while domestic usage has been pretty strong as well. We're also crushing a record amount of soybeans. Exports, however, that continue to be, disappoint, despite China fulfilling their obligation to buy 12 million metric tons of U.S. soybeans. Still no indication of Chinese interest in new crop as they've shifted their demand to the cheaper South American supplies. So we saw prices spike at the end of last year's harvest with a return of Chinese buying, but that speculators quickly sold that off, unwound these long positions as the South American production prospects have improved. So I'm thinking corn's going to remain kind of in a sideways 415, 440 type range, and maybe 1060 or 1035, 1085 here on spot beans. We do have a few things on the horizon, however, that could lead to a pickup in volatility next month. The Trump administration is expected to announce, or at least start to provide some clarity on the renewable fuels and the mandated blending requirements, along with potential reallocation of these small refinery exemptions, and also this 45Z tax credit. Then, of course, we got the USDA reports here at the end of the month of the stocks and acreage data.
Mark, how about a quick summary as to how the speculators are positioned in the ag space?
We've not seen speculative traders holding anywhere near record long or short position across the entire ag space. Most recent CFTC report did show money managers were net buyers across the ag space in the past week. The largest net change was in soybean oil, where they did buy about 39,000 contracts that flipped their position back around to net long, but it's only 13,000 contracts. They're holding a similar position right now in the soybeans. In corn, they're short about 70,000, 90,000 in the wheat, and about 32,000 in the meal. Not historically sizable positions. Index funds there too. They were net sellers in the most recent week, and they've trimmed their holdings now to the smallest positions they've held in the ag space now in just over 3 months.
Thank you, Mark Bowman. Thanks for being patient. Cocoa prices have fallen from $6,276 per ton to $3,940 per ton since January 9th. This is a 37% drop in just 3 weeks. And since October, the cocoa's down 53%. What forces do you think can help stabilize the market?
Okay, well, let's start with these prices are down simply because due to lower demand and higher supply. Fourth quarter grind data from Europe and Asia that was released in mid-January showed bigger than expected declines from a year ago. And that drove home the idea that they rallied to all-time highs of almost $13,000 per ton in 2024, a significant effect on demand. Confectioners cut back on the amount of chocolate they were using in their products, using thinner chocolate coatings, offering more non-chocolate candy and Halloween. And grinders cut back grindings and allowed their inventories to drop. Now this year, this 25-26 marketing year, cocoa regulators in Ivory Coast and Ghana raised their official farm gate prices. This is the official prices the buyers would have to pay their farmers. And this did encourage more production, but it also, unfortunately, exporters are just not paying up. There were reports last week of supplies backing up and piles of beans around. And this also, though, suggests that the 2025 main crop that began in October is running pretty good. It kind of altered the idea that low port arrivals that we were seeing had something to do with low production, maybe due to the lack of buyers. Now, and on top of that, West Africa's weather has been good. Their dry season, usually arriving in late part of the year, was late to arrive. The Harmattan wind, which dries the trees out, has been mild. And they've had above average moisture in December and January that have allowed the pods to grow to good rate. This also points to a strong finish to the main crop and a strong start to the mid crop. So what can support the market from here? Well, one thing, the Ivory Coast regulator, the CCC, has committed to buying cocoa directly from farmers to take it off their hands. Their intention is to eventually sell it. But this may act as a bit of a stopgap. And eventually the buyers may step in if they sense the decline is over. Grinders will eventually need to replace their supplies. And as Kurt said in the question, we're already down almost over 50% since October. So we are reaching a point where the prices may actually be low enough that these grinders will need.
One last question, Mark. What's in store for the natural gas market?
So last week we had that extreme cold that moved into the U.S., the eastern half of the U.S., extremely cold temperatures in the north and unusually cold temperatures in the south that affect on production as well as demand. But now it seems to be on the way down. And 6 to 10 and 8 to 14-day forecast today show that the area of below normal temperatures is shrinking eastward, out of the Midwest and out of the western Great Lakes, and as well as most of the southern U.S. Still be cold in the east, but at less extreme levels. We really have about 2/3 of the country looking at, or even 3/4 of the country looking at above normal temperatures out into mid-February. This will not only pull back consumption, but it, has already helped ease the severe drop in production last week. Last week we had frozen well camps, particularly caps down in Texas and Oklahoma, that brought production down to a 2-year low of 92.5 billion cubic feet per day. That's last Sunday. Friday it was back to 105.7. So we look for the storage report this week to show some significantly tightening supply due to that cold last week. As of last week's report, which was as of January 23rd before the freeze, U.S. storage was 11.4% above a year ago and 10% above the 5-year average. Now there's some ideas we're going negative against the 5-year average for this Friday's report, which is Friday. This is probably only a temporary shift with this warm up coming. Longer term, we have power needs for artificial intelligence, cryptocurrencies, data centers that can provide a power demand support for natural gas over the longer term. We've seen a huge big swings, and we're likely to stay inside that range for a while.
Thank you all. Remember, the views and opinions expressed today in this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.